I hope all of you know what is an asset. Asset is something which will generate income for you, revenue for you. Anything that generate revenue for you, okay, in the present or in the future, it is known as an asset. Is that okay? Anything that generates revenue. Okay, like for example, you have a house. It's an asset because you can get rent from the house or you can sell it in the future. Similarly, bikes, cars, they're also assets because in the future you can sell it. Fruits, vegetables that you have is not asset because it is not going to generate any revenue in the future. So asset is that. Liability is what? Something which you owe to someone else. Something which you have to return is a liability. Next, receipt. When we say receipt, any money the government gets is receipt. It includes both income as well as loan. Both income as well as loan. The money the government spends is expenditure. So with that, let's move on to the more important ones. So the government budget, no, just understand. Now don't write down. I will put up those slides. You just understand this. Then you can write down. So the government budget, okay, can be classified. Even your house budget. So you take your house as an example and understand this, it's enough. Okay, so the government budget can be classified into receipt and expenditure. Yes? Receipt means any money that the government gets. Expenditure is any money that the government spends. So there are two types of receipt. Let's take your house as an example and then we'll move on to the government. So any money that you receive can be classified in your house also. It can be classified into revenue receipt and capital receipt. So by definition, which is what you should use to identify the answer in your multiple choice question. So in revenue receipt, it should not increase liability. Neither should it reduce asset. So before that, you tell me what are the sources of money in your house? Salary, somebody's salary, your or your parents or your spouse. Okay, salary, pension. Okay, in your house, what are money you get? Rent. Okay, interest, deposit you have kept in the bank for which you are getting interest. Okay, then you sell your car. Okay, you borrow money. Correct? No, you borrow money also. No. I'm talking about all kinds. Now we'll categorize it. I'm just giving you each one. Okay, borrowing money, etc. All these are your sources of money. So which one comes under revenue receipt? Which does not increase liability. It should not increase your liability, meaning you should not give it back. It's your own money, or it should not reduce the assets. So salaries, is it creating any liability? Is it reducing your asset? No. Similarly, pensions, rent, interest, is it reducing your assets? Is it creating any new liability? No, it is your own money. You don't have to give it back. Neither is it creating any liability. So such kind of receipt. Whereas selling your car, what will happen? Selling your car or house, you will get money. But what is happening? Your asset has reduced. When you sell your house, asset has reduced. So that comes under capital receipt. Similarly, borrowing, what happens? You borrow 1 lakh from your friend. You are getting that money, but that money involves liability. So capital receipt is any receipt which creates liability, or it should reduce asset. If anything, that go by this definition, nothing else. Don't get confused, and in books and all there'll be all different ways asked. But you use only two things. What is that? Asset and liability. If it is increasing liability, If it is reducing asset, it is capital. Okay, your salary, pension. I'll give you another example. Let's say your parents gave you a gift of 10 lakh rupees. Your parents gives you 10 lakh gift. Your wedding is there, they give you 10 lakh gift. What kind? You got 10 lakh. It's a receipt. But what kind of receipt it is? Revenue receipt. Why? Because the gift that your parents gave you is not creating any liability, nor is it reducing any asset. So it is what kind? Revenue receipt. You have invested in shares, okay, and you are getting profits from that, dividends from that. You have invested in Infosys, and Infosys share is increasing. They're giving you dividends. Every month you are getting 2,000 rupees. What kind of receipt it is? Revenue receipt. Correct? Because it's not creating any liability, nor is it reducing your asset. Now let's say tomorrow you need some bulk money. You want to buy something. You sell Infosys share and you get 2 lakh rupees. What kind of receipt it is? Capital receipt. Because you have reduced your, as simple as that. Is that okay? So capital receipt, any receipt that creates liability or it should reduce asset. Creates liability or reduce asset. I will put the slides, you can write down then. Is that okay? Next is expenditure. Expenditure also can be classified into revenue expenditure and capital expenditure. Same thing with respect to liability and asset. So any money that you spend, if it does not create asset, or reduce liability, it should not create asset or reduce liability, then it is known as revenue expenditure. In your house, you tell me what all expenditures you have. You have expenditure on food, electricity, then on rent you pay on interest. You have taken loan, you are paying interest, or you are repaying loan, you are buying a car. All these are expenditures. Anything else? What you are saying? Fees. Okay. You are paying big amount for institutions. Okay. Fees. Okay. So all these are your expenditures. Okay. So revenue expenditure should not create assets, nor should it reduce liability. Capital expenditure should create asset or should reduce liability. It should reduce liability. Now take your example. Fees. Is it creating any asset? Yes, you can talk intellectual asset and all that, but that's not it. Financially, is it creating any asset? You are spending money, gone. Okay, so it is what kind? No asset is created, neither liability is reduced. So it is what kind of expenditure? Revenue expenditure. Food, electricity, rent. Is it creating any asset? Nothing. So it is revenue expenditure. Interest payment, is it creating any asset? Nothing. So you are paying interest. He is profiting, but you are not. Then repayment of loan, you have repaid the loan. So it has reduced the liability. You had taken 1 lakh loan. Now you are repaying that loan. No more liability. So that is what kind of expenditure? Capital expenditure. Then last one, buying of car or a house. It's creating an asset. So it's a capital expenditure. As simple as that. You take your house, any income expenditure, you can put it under these headings. Same thing with respect to government also. So government revenue, something which should not create liability or should not reduce asset. Like for example, tax. The government gets tax. Is the tax increasing liability or reducing the asset? So tax is a revenue. Fine, fees, the government collects. Now you skip signal, you pay fees, you pay fine. Yes, the government gets that money. Should the government give it back? Is it reducing any asset? So it is revenue receipt. Agreed? Then the government had Air India last year. This year it sold it off. How much money it got? Some 1,000 crores. Okay. What kind of receipt it is? Capital, because it reduced its assets. So as simple as that. Similarly, expenditure, revenue expenditure, which does not create any asset or liability, reduce liability. Now government spending on salaries, subsidies, pensions, law and order. Yes, so defense, it does not create any asset. Is that okay? So it is revenue expenditure. Government builds infrastructure. It is capital expenditure because it's creating asset. It can collect tolls from them. Before we go into the next definition, just understand this. You might have heard about this Sukhanya Samriddhi Yojana. What is this? So basically, to promote female child welfare, okay, or to promote female sex ratio, okay, and to reduce female infanticide. So the government has come up with a campaign called as Beti Bachao, Beti Padhao Andolan. One of the things that the government is doing has come up with a Yojana scheme called as Sukhanya Samriddhi Yojana. So what is this? Basically, money is deposited in the name of the girl child in post office or in any other recognized bank. Okay, so they get 8.5 interest. Okay, parents or the guardians can invest from anywhere from 240 rupees, 250 rupees per year to almost 1.5 lakh per year, for which the government will give 8.5% interest. So what are you doing here? The beneficiary is doing what? Depositing money in the post office or with the government, okay, in the name of the girl child and giving interest. So the government is receiving this money. Yes, let's say you are depositing 1.5 lakh rupees in the girl child's name. Every year you are depositing 1.5. That means the government is getting 1.5 lakh every year from you. So what kind of receipt it is? The government is receiving it. Is it revenue receipt or capital receipt? Revenue. Why is it revenue? It is creating liability. Yes or no? See, that's why go by the definition. Definition says it's creating liability. Isn't it creating liability? The government has to repay back the money and it has to pay interest. When it pays back at 21 years or when the child gets, when the girl gets married, not child, child marriage, not that. So when the girl gets married, right? So that is what it is. So what type of receipt it is? The government is receiving it. But what kind of receipt it is? Capital receipt. Yes, online students, correct. Capital receipt. Similarly, there are so many other schemes. Now you want to invest money, okay, save some money. You will go to the post office and open a national savings certificate, NSC, and you'll go on depositing money. Again, government is receiving this money, but what kind of receipt it is? Capital, because the government has to repay it back. Provident fund, national pension scheme, where you will deposit money for your old age. What kind of receipt it is? So don't go by recurring or non-recurring. Recurring it is, but it is still capital. Why? It is creating liability. Okay. Next. Okay. So now let's go a little bit, further properly we'll classify. Now the definition and all is clear. Okay. So just put this flow chart. Okay. So you have the budget, whether it is union budget or the state budget. It can be classified into revenue and capital account. Revenue account and capital account. Revenue account has revenue receipt, revenue expenditure, capital receipt and capital expenditure. Or, if you are getting confused, you can simply put it as budget as expenditure and, income and expenditure, receipt and expenditure, receipt as revenue and capital receipt, like that also. So these are the four headings which we have already defined. Okay. So what is revenue receipt? revenue receipt should not increase liability nor reduce asset. So definition you have understood. So in our budget, revenue receipt is of two types: tax receipt and non-tax receipt. So taxes can be further be classified into direct tax and indirect tax. So both these, okay, so it should not create any liability. Tax does not create liability nor reduces assets. It's your own money. Okay, so you have direct and indirect taxes. So what is direct tax? The liability cannot be transferred. If the liability can be transferred, it is called as indirect tax. For example, income tax. For example, income tax. Income tax, the liability cannot be transferred, meaning when the tax is levied on me, it is to be paid by me. I cannot tell my neighbor to pay it, or I cannot tell somebody, I cannot tell my students to pay it. Tax is levied on me, I have to pay it myself. Okay, the liability or tax incidence cannot be transferred. Okay, whereas indirect tax, the liability can be transferred. Take for example, GST. So the GST, let's take hotel. The GST is levied on the hotel, but the hotel will transfer it to the consumer. So when you eat, you don't just pay for the food, but also pay for the tax, GST. But who is paying the GST? Who is it levied on? It is levied on the hotel. Who is paying it? Consumer. So when the burden is shifted, okay, the manufacturer, tax is levied on manufacturer, but he will not pay that tax. He will transfer it to the consumer. He will say 100 rupees is the cost, 20 rupees is the tax. So total 120 rupees. Is that okay? So when the tax liability can be transferred, it is known as indirect tax. Example, GST. When the tax liability cannot be transferred, it is direct tax. Example, income tax. Then you have non-tax revenue receipts. So examples, or what are the things? So you have profits and dividends. Profits and dividends. So dividends is basically when you have invested in shares, and when the company makes profit, the profit is shared between the shareholders. Same way the government would have invested in different shares. When they make profit, they are shared. So profit and dividends. Profit is like government has companies, okay, like Coal India Limited, okay, Shipping Corporation of India. So they're all making profit. Oil, HP, Hindustan Petroleum, they make profit. So that is that. Okay, it is recurring in nature, but that's not the definition. What's the definition? It should not reduce asset nor increase liability. Profit will not increase liability. Okay, then interest that the government earns from the loan it gives. Yes, interest received by the government. So central government would have given loan to the state governments. So state will be giving them interest. Okay. Next, fine and fee. Fine and fee. Yes. So penalties and other things. Then service charges. Services charges. Government provides electricity, water, for which it collects money. Yes, irrigation and all that, it collects money. So service charges. Government has schools from which it collects fees. It has hospitals from which it collects money. So all those are revenue receipts. Then grants, the government receives. Gifts, the government also receives gift. For example, the Bangalore Metro, some parts of metro has been granted by the Japanese government. So you can see in Bangalore, in MG Road Metro, okay, there is a board funded by in collaboration with Japanese aid system or something. Okay, so like that. So grants, that also is revenue received. Why? Because it is non-debt creating, does not reduce asset. Okay, so profits, interest, fine, fees, service charges, grants, these are all part of revenue received. Expenditure, revenue expenditure, those expenditure which should not create any asset nor reduce any liability. Basically, these are wasteful expenditure, but necessary expenditure. For running the government, you need it, but they are wasteful. Spent means it is gone. Okay, say for example, salaries, pensions, expenditure on law and order, expenditure on law and order, expenditure on defense, except those on capital acquisition, maintenance. Okay. Then subsidies, social service. Social service like on education, healthcare and all that. Child development and things, whatever, schemes and programs, subsidies and all that, maintenance, defense, law and order. Okay. Similarly, the grants you give, grants given. So India gives grant to Afghanistan. India gives grants to Bhutan. Now, we gave how much, some oil to Sri Lanka, some 10,000 liters or what, something like that. Okay, vaccines. Okay, so like that, when we give money, is it creating any asset to us? Is it creating any, reducing any liability? Nothing. Only for friendly relationship, etc., we do that, but they are revenue expenditure. Is that okay? Salaries, law and order, defense, maintenance, subsidy, social service, grants. So they are examples of revenue expenditure. Agreed? Next, capital receipt. So capital receipt is of two types: debt creating and non-debt creating. So debt creating, loans, correct? Debt creating are loans. So government can borrow from public, like through various schemes. The National Savings Certificate is nothing but government borrowing from public. Or it can borrow from financial institutions, banks and other NBFCs. It can borrow from other country or other international financial organizations like World Bank, IMF, etc. Then non-debt is that leads to reduction in asset. So when we sell, example, disinvestment, capital expenditure, that which creates assets or reduce liability. So here, investment in asset, repayment of loan, correct? We have borrowed money, we are now repaying that loan. So it is reducing liability. Because it is reducing liability, it is capital expenditure. Investing in asset. So when you give loan to somebody else, that is creating asset. So giving loan also is a capital expenditure. Investing in asset, both giving loan or investing in asset are creating asset. Repayment of loan is reducing liability. We'll come to this. So just answer this question. Rule out. So let's see. First statement, purchase of new fighter planes. Is it revenue expenditure? No, it is creating an asset. So it is a capital expenditure. So therefore, this is a wrong statement. You rule out option C and option D. Then subsidies. Is it creating asset? No. Is it reducing liability? No. So therefore, it is revenue expenditure. So it is correct. So which one you can rule out? Option B. You've already got the answer. Further, we'll confirm it. Salaries, it is revenue expenditure. So 2 and 3 is there. Next, repayment of loan. When you repay back the loan, you're reducing the liability. So it is capital. So this cannot be the answer. Buying shares is increasing your asset. So this cannot be the answer. So your First choice, that is 2 and 3 is correct. A is the answer. Next. Which of the following is included in the capital budget? So again, in your exam, always mark the keyword. So what is the keyword here? Capital budget. What is the keyword here? Correct. So which is correct with respect to capital? So expenditure on acquisition of assets. It's a capital expenditure. So one is correct. So which one you can rule out? Option B. Creation of asset. Loans received is increasing liability. So therefore it's a capital received. So you can rule out option A and option C. So you already got the answer. Let's confirm. Loans and advances granted to the states. When you give loan, what is it? It is creating asset. So that's also capital. So answer is all. Agreed?